Have you ever looked at the headlines and wondered how we got here? A national debt soaring past $36 trillion. A wealth gap wider than any time since the Gilded Age. A future where the interest we pay on our debt could cost more than our entire military budget. This wasn't an accident. It wasn't one event or one administration. It is the direct, predictable result of 4 pillars of financial policy. 4 sets of decisions made by both parties over and over again for the last quarter century. This is the story of how those choices intertwined, creating a cycle of consequences that now defines America's economic reality. The story begins with a simple but dangerous habit: spending far more money than we take in. Every single year since 2001, the U.S. government has run a budget deficit. This isn't a partisan issue, it's a bipartisan tradition. It happened in 2 ways. First, we cut taxes, a lot. Successive waves of major tax cuts, notably in 2001 and 2003, and again in 2017, dramatically reduced the government's income. The 2017 Tax Cuts and Jobs Act slashed the corporate tax rate from 35% down to 21%. Proponents promised these cuts would unleash a wave of economic growth that would make them pay for themselves. That didn't happen. Instead, the 2017 law alone was projected to add nearly $2 trillion to the debt over 10 years. And the benefits flowed overwhelmingly to the top. The Bush tax cuts boosted the after-tax income of the top 1% by nearly 7%, compared to just under 3% for the middle class. Second, while revenue was falling, spending exploded. The wars in Iraq and Afghanistan were financed almost entirely with borrowed money. Then came the crises. The 2008 financial meltdown and the COVID-19 pandemic in 2020 prompted the largest government spending surges in modern history. The response to the pandemic alone amounted to an unprecedented $4.6 trillion in relief. The result? A national debt that has skyrocketed from under $6 trillion in 2000 to over $36 trillion today. But the real danger is the interest. In 2024, the net interest we paid on the debt hit $882 billion, more than the entire budget for national defense. This creates a debt spiral. We have to borrow more money just to pay the interest on our old debt.
As the government was borrowing trillions, another, more secretive part of the story was unfolding at the Federal Reserve. To fight the 2008 crisis, the Fed cut interest rates to 0. When that wasn't enough, it unleashed a radical new policy: quantitative easing, or QE. In simple terms, the Fed started creating trillions of digital dollars to buy government bonds and other financial assets. This injected a sea of cash into the banking system, and it pushed up the price of financial assets, like the stock market. But here's the catch: who owns those assets? In America, the wealthiest 10% of the population owns almost 90% of all stocks. The top 1% alone holds over half. So a policy that works by design to inflate asset prices will, by its very nature, disproportionately benefit the rich. This became a primary engine of modern wealth inequality. Researchers call it the snowballing effect. The rich use their higher incomes to buy assets. QE made those assets surge in value, and the gains were reinvested, accelerating wealth concentration at the very top. Then the party ended. Post-pandemic inflation, the highest in 40 years, forced the Fed to slam on the brakes. They began quantitative tightening, or QT, and hiked interest rates at the fastest pace in history. This is what finally exposed the danger of Part 1. The easy money was gone. Suddenly, the interest on that $36 trillion debt became incredibly expensive, and the debt spiral began to accelerate.
The 2008 crisis wasn't just bad luck. It was a catastrophic failure of financial regulation. The government's response was the Dodd-Frank Act of 2010, a sweeping law meant to end too big to fail and protect consumers from predatory practices. It created new agencies and forced the biggest banks to hold more capital to prevent another collapse. But from its birth, the law was controversial. Critics argued it crushed smaller community banks with costs they couldn't afford, while others argued it didn't solve the too-big-to-fail problem but actually made it worse. These arguments won out. In 2018, a bipartisan bill rolled back key parts of Dodd-Frank. Most importantly, it raised the asset threshold for the strictest oversight from $50 billion to $250 billion. This single change exempted dozens of large regional banks. Just 5 years later, in 2023, some of those very banks, like Silicon Valley Bank, collapsed spectacularly, forcing the government to step in once again. It was a perfect, painful illustration of America's regulatory roller coaster, a cycle of crisis, regulation, deregulation, and then back to crisis.
The fourth and final pillar was a dramatic reversal in trade policy. In 2018, the U.S. launched a full-blown trade war with China. Tariffs were imposed on hundreds of billions of dollars of goods. The stated goal was to fight unfair Chinese trade practices and bring manufacturing jobs back to America. But there was a fundamental miscalculation about who pays for tariffs. The idea was that China would bear the cost. But study after study confirmed the economic reality. Tariffs are a tax paid by domestic importers who then pass the cost to consumers. The trade war acted like one of the biggest tax hikes in decades. It cost the U.S. economy an estimated 300,000 jobs and wiped out at least $1.7 trillion in stock market value. American farmers were devastated as China retaliated, losing the majority of what was once a $24 billion market. And did it bring manufacturing back? Mostly, no. Instead of reshoring, companies simply moved production to other countries like Vietnam and Mexico to get around the tariffs. This is called trade diversion. The U.S. trade deficit with the world didn't shrink. It just changed its address.
These four policies didn't happen in a vacuum. They were a toxic cocktail. Easy money from the Fed made it politically painless for the government to run huge deficits. The economic pain from globalization fueled the political anger that led to the trade war. The result is a long-term outlook that the government's own nonpartisan scorekeepers call unsustainable. The Congressional Budget Office projects our national debt will reach 156% of our entire economy by 2055. They warn of slower growth, exploding interest costs, and a rising risk of a true fiscal crisis, where investors simply lose faith in the U.S. government's ability to pay its bills. But this is more than just numbers on a spreadsheet. It's about the social fabric of the country. These financial decisions have systematically widened the gap between the rich and everyone else. We have created two Americas, one that owns the assets and one that owes the debt. Reversing course means facing up to the consequences of these past decisions and having an honest conversation about the difficult choices required for a more stable and shared future.